contentious issues in private business valuations. Number 3. Well, it's not number 3. This is a fill-in. It's an add-on to the first session where I talked about price and value. And I said that value is an intrinsic concept, and it comprises of simply 2 components, cash flow and discount rate. I'll deal with the cash flow first. Cash flow in turn is made up of 3 key components: revenue, margins, gross profit margins, net profit margins, and growth, earnings growth. And the good news is that accountants are good at cash flows, or they should be, hopefully. The other good news is that cash flows should be the largest part of valuation. The focus should really be on those cash flows. The potentially bad news is that we're looking at future cash flows, not what's happened in the past. And accountants typically are used to looking at the past. Now, this can be used as a guide, but it won't necessarily tell us exactly what's going to happen in the future. And it might be we need to start turning to statistics, standard deviations, distributions to come up with some good forecasting. So that's cash flows. And also within cash flows for private businesses, we have what we call normalizations, adjustments for transactions, amounts that haven't been correctly accounted for. For example, salaries not a market value, or related party transaction not a market value. So that's cash flows. Then we have the discount rate. So the discount rate is the rate required to reflect the risks incurred by the investors. And that discount rate, to a certain extent, will depend on the types of cash flows. Now, if we use cash flows that are before any interest expense, but after tax, we use what's called a weighted average cost of capital, a WACC. And the weighted average cost of capital comprises of the return required by the investors, the equity investors, that's our cost of equity, and the return required by the debt holders, our cost of debt. And the WACC, the weighted average cost of capital, is weighted according to how much debt and how much equity is held in the business. So what about our cost of equity? Well, our starting point for calculating cost of equity is our foundation, our risk-free rate. What rate of return can an investor expect on a risk-free investment? Now, again, we need to distinguish between real cash flows and nominal cash flows. So real cash flows are adjusted for inflation, nominal cash flows are unadjusted. If we work on nominal terms, then we use a nominal risk-free rate. And a good go-to source is the 10-year government bond. That's a nominal rate. But even the risk-free rate is full of controversy and disagreement. You think we'd be able to agree on a risk-free rate? But that's our foundation. We have our starting point. So then we want to know about how much more does a equity investor require above a risk-free rate? How much more risk is in this business? And we can look at the markets for guidance. And we can look at what's called the capital asset pricing model, CAPM. Now, the CAPM is a model that was developed and it's full of controversy, has its flaws. Some of the flaws in the model are that it assumes a normal distribution of returns, which doesn't happen. It assumes investors are rational and are fully informed, which again doesn't happen. But it's a good guide, and it's the best we've probably got. And so most professionals in corporate finance use the CAPM, or many do. So what does the CAPM say? Well, the CAPM says, okay, well, we have our risk-free rate, and then we're going to add on the equity risk premium, the premium the investors require. And we can look at what a market portfolio, what the market returns on average to investors. Now, importantly, CAPM assumes that we have a diversified portfolio. Our investor has a diversified portfolio. So then when we come to look at the cost of capital for a new investment, all we're concerned about is the additional risk exposure that investment will add to the portfolio. What additional risk and return will it add to the portfolio? Because we're only concerned about diversified portfolios, we're only concerned about systematic risk. And what the CAPM says, or rather portfolio theory says, is that investors are only interested in systematic risk. So what is systematic risk? Systematic risk is risk that's endemic to the markets. For example, change in the economy, change in the political situation, and it affects all stocks. But some stocks are more sensitive than others to systematic risk. So, for example, if there's a downturn in the market, you would expect supermarket cash flows, sales, and so returns to be less affected than, say, for example, luxury goods. And we reflect this sensitivity in simple terms with what we call the beta. And the beta reflects the correlation between the movements in the market and the movements in the stock, the returns. And so if we have a beta of 2, simple terms, we say, well, our stock is twice as risky as the market. So what does all that mean? Okay, well, let's work it back. So we had our risk-free rate. So say like we take the risk-free rate at 3%. Then we need to work out our equity risk premium. And there's different ways to do that. We can look historically, what's happened in the market. We can look at what the market's telling about going in the future. We work out our equity risk premium. But say it's 7%. And the portfolio as a whole will have a beta of 1. So the return for our portfolio will be 10%. If we then want to work out the return for that additional investment, we look at its beta. So say, for example, our luxury good is 2 times. We times 2 times the equity risk premium, 2 times 7, 14%, plus our risk-free rate, 3%, gives us 17%. And that's roughly how it works, the CAPM in simple terms. So that's our cost of equity. Then we have our cost of debt. Cost of debt is a function of default risk. How likely is this company to default on paying the returns, the interest, and returning their capital for the debt? And the larger the default risk, the higher the cost of debt. And at some point, clearly, you won't be able to borrow any more money. Now, cost of debt is going to be lower than cost of equity normally because there's more security with cost of debt. You've got security over the assets of the business, whereas equity holders at the bottom of the pile don't have that security. So it makes sense then to take on more debt if you want to reduce your cost of capital. And a lower cost of capital improves the value of the business. But there's a trade-off, because as you take on more debt, there's more default risk, but also the equity holders want to be compensated more because they're having a squeezed balance, there's more chance that they're not going to get money out of the business. So we've got cost of equity and cost of debt. And then finally, we need to look at our percentage of debt to equity. Are we going to value the business with a current ratio, or are we going to look at optimal ratio, or the ratio you see in the markets? Another factor we need to consider.